Hello, thank you for joining Techie Personal Finance Bootcamp. I know I was supposed to be taking some time off between season 1 and season 2, but I'm right in the middle of starting to gear up for tax season. So I do tax planning with my clients at Level Up Financial Planning, but I also launch a tax planning and tax filing called Power Up Tax Planning Services. So I'm super excited. There's a lot of common questions that people have when it comes to their taxes, and I'm going to be recording a couple of quick episodes to just kind of tackle these different things. So hopefully they won't be too long, but they will be pumped with information that hopefully you can use and just have a better understanding of how taxes work and how. So today's episode, I'm going to be tackling marginal tax brackets and your effective tax rate. So a lot of times people don't realize that you're probably not paying as much in taxes as you think, because a lot of times you lump in together what Social Security and Medicare and your state taxes are. But from the federal taxes standpoint, it's actually not as much as you think that you are paying. Even if you end up being in like a 24% tax bracket, you're not paying 24% on all of the income that you earn. So that's a big thing to know. So your marginal tax bracket is the bracket that you kind of finally fall into. And most of the time, it's just going to be pretty cut and clear that, oh, if you're in the 24% tax bracket, then that's the marginal tax rate that you have. Basically, that's any additional dollars that you earn, that next dollar is going to be paid at that amount. So if it was the 24% tax bracket and you earned an additional $1,000 and that you still stayed within that bracket, then you'd end up paying $240 because that's 24% of that $1,000 that additional that you earn. So that's how the marginal tax bracket works. Once you get up to that next bracket, the dollar that pushes you into that next tax bracket would make that a marginal tax bracket for 32%. So those numbers seem high, right? So 24, 32%. And again, it's only on your higher earned income. The U.S. tax rate system is progressive, so you actually start out paying lower taxes on the first few $1,000s earned, and those things gradually increase. So you pay nothing on the kind of standard deduction that you're allowed. So if you're married filing jointly, it's double than what if you're a separate single filer. Then there's that first tax bracket that you hit, and that's the 10% tax bracket, then it's the 12%, then it's 22, 24, 32, 35, and then finally 37%. So again, you're not paying that 35% or 37% on all of your income. It's just kind of as you cross these different thresholds, that income that fits in that kind of bracket ends up becoming taxed at that rate. So because you're not paying that same amount across all of your income, that's why there's a different number that is actually more relevant and may make you feel a little bit better. It's called the effective tax rate. So the effective tax rate is a little bit simpler of a calculation because you just basically take the amount of taxes that you end up owing. So, and I'll pull up an example here in a second, but let's say you owe $10,000 in taxes and you had $100,000 of gross income. Well, that would be 10% because you just put the taxes and divide that by the actual gross income that you generated for the year, and that makes your effective tax rate. So now we can dive into a quick example I just kind of made for this video specifically. So this is a look at a few different things. So it's an example of a couple married filing jointly. Their income is $150,000 and they're saving 10% of that towards their 401k contributions. So it's $15,000 for that. That gives them an adjusted gross income of $135,000 because it reduces your taxable income if it's traditional 401k contributions. And then from there, they're able to take the standard deduction. And since they're married filing jointly, that is $24,800. If you're a single filer, it is half of that, so $12,400. So just be aware that your numbers may be a little different depending on your filing situation. So once you deduct that standard deduction from that, then your AGI minus the deductions is $110,200. So that's when you start to be able to calculate your income tax before the credits. And so you might have additional deductions that you're able to do. You might end up having different credits on what I'm showing. I'm just showing some quick, easy ones just for illustrative purposes, but these aren't the only things that exist that could help reduce your income or increase your income for that matter. So just make sure that you're not saying, oh, this is the only things I have to worry about, that you may have different things going on. This is just for simplicity's sake. So income tax before credits, $15,824. That's what it would be, but They do have one child, and the child tax credit is $2,000. So that actually takes $2,000 straight off of the income tax due. So the new total is $13,824. And by using those numbers, kind of show you their marginal tax bracket is the 22% bracket. So if they earned another $1,000 and still managed to stay within the 22% bracket, then they pay $220 on that additional $1,000. Or if you just want to look at it, the next dollar that you earn. So if they earned an additional dollar, they're going to pay 22 cents in taxes on that next dollar earned. The effective tax rate, again, we're taking that actual amount in taxes they end up paying and we divide it by their gross income. So that came to 9% for this family. So hopefully that gives you a quick run through as far as the differences between your marginal tax bracket and your effective tax rate.